how is the market move and market makeup going to change over the next number of months and quarters?
So we're still upbeat about the market, but we think the things that have done phenomenally well over the last 13 months are going to slow down. Technology, the Magnificent Seven or Five, started this year on a roll. We think that's going to slow down. And then areas that have not done nearly as well, we think are selling at much more reasonable valuations are going to be the next leg. That would include things like healthcare, the utilities, drug companies, financials, industrials, all really have not done a lot. Stocks sell at about 14 to 15 times earnings. We think that's the place to make money.
Yeah, I saw a chart on X, formerly known as Twitter, over the weekend with Charlie Bilello of Creative Planning, and it said that the 10 top holdings in the S&P 500 are now over 32% of the entire index, which is the highest concentration going all the way back, and maybe ever, to 1980. 10 stocks, 32% of a 500 stock index, taking nothing away from the NVIDIAs of the world, David. That does not seem super healthy to me.
Well, we think it's healthy that these businesses have been doing phenomenally well and really have grown significantly. Historically, however, you're exactly right. When companies get that big as a part of the index, they generally will start to slow down. There are changes in leadership. If you look at things on a valuation basis, those largest 10 stocks are probably selling north of 30 to 35 times earnings, where a lot of the market is selling at 15 to 17 times earnings. We think the answer is somewhere in between. Clearly, the mega cap growth stocks have great growth prospects, but we think they're a little bit fully priced for that. And we think some of the companies that are having flat to modestly higher earnings this year don't have great near-term prospects, but they have good intermediate-term prospects, and you're getting them at really good prices. So that's where we'd be putting the money.
Why do you like an American Electric Power? Just a big old kind of boring utility.
It's a boring utility that grows at 5 to 7% per year. The dividend grows nicely over time. You're getting it at about 14.5 times earnings, a 4.6% yield. Utilities have been one of the worst performing groups over the last 12 months. We think the Fed is going to be lowering rates as the year progresses. We don't know whether it's going to be May, June, or July, but it's going to happen. And we think when that happens, when rates start to go down, when money market rates start to go down, people are going to start to move back to utilities. You want to buy them early. You're getting them at a great price.
Yeah, also a PNC Financial. And again, I'll use the term boring. It's a bank. It's a financial advisory firm. It's got a lot. It's very big, by the way, but it's not J.P. Morgan. Doesn't get a lot of attention.
One of the great things that you want to focus on in banks is boring. You want a bank that's sort of under the radar, makes a lot of money, good balance sheet, good credit, and that's exactly PNC. They pay a very healthy yield, low PE. We think that banks are going to do better this year as it progresses. We don't think the New York Community Bank is going to really spread out to the other banks in the group, especially the biggest banks, and we'd be buying into this recent dip.